Hi guys, and welcome to another Week 8 video. Now in this upcoming week, our focus will turn firmly to the risk sentiment in the market. There's a couple of events coming up in terms of data points that can create some big moves in equities which can result in full risk on or risk off flows. And of course, we also need to consider all of the developments with regard to the coronavirus and how that impacts the world economy. So turn with me now to the video to see exactly how we're preparing for this week's upcoming events and how we can look to trade them in this upcoming week as well. Okay, then taking a quick look at the baseline for the current risk sentiment. Now, risk sentiment has arguably taken a turn for the better over the last 2 weeks, and the main reason for that has been a couple of factors. What is important, though, is that the majority of analysts are still expecting this to be merely the quiet before the storm, with people like the IMF's managing director currently saying that the current global recession is going to be way worse than the global financial crisis of 2009. According to IHS, the JP Morgan global PMI also dropped to its lowest level since the height of the global financial crisis, and at the current pace, the data compiled between the 12th and the 27th of March indicate that global GDP is set to drop to close to 2%. Now, one of the big concerns resulting from the current lockdowns around the globe is the biggest drop in global services activity ever recorded. And according to the Bloomberg's Economic Global GDP Tracker, that paints a similar bleak picture to that of the IHS. The tracker's March reading puts the annualized global GDP at 0.5% year over year, which is a very sharp fall from January's 4.2%. And with the current lockdowns continuing around the globe, these numbers are expecting to be worsen considerably over the next couple of months. Now, in an unprecedented reaction, almost 17 million people have filed for unemployment benefits in the US alone in less than a month's time, basically in 3 weeks. Now, for many analysts, this implies a total US unemployment rate of between 12 and 14%. Now, the debate whether the globe is heading for a recession has been confirmed by loud and clear preliminary data. And the new debate now raging on is how deep and how long we can expect this current recession that we are already in to last. Now, according to IHS, the current preliminary data, PMI data, does suggest a downturn which could be far bigger than that of the global financial crisis fallout. And we can see from these 4 charts for the US, the UK, the Eurozone, and the Japan that the numbers are just staggering. Initial numbers suggest that the US economy could contract as much as 5% year over year in March, and that the Eurozone economy is currently approaching an annualized contraction rate of 10%. So if the situation is so bleak, why has risk sentiment taken a slightly better turn recently? Now, the answer for that is threefold. We have oil prices, also better than expected COVID-19 data, and then stimulus. Turning to COVID-19, the most recent data has shown some signs of hope, especially in places like Italy and Spain, where we're currently seeing a plateauing in terms of the confirmed cases and fatalities, and that has given the market some reason to feel better. However, we've also seen an aggravation in places like the UK and the US, where the battle has just started. Other reasons for optimism has been unprecedented monetary policy and fiscal stimulus provided by major governments and central banks. Some examples are the ECB launching a €750 billion emergency purchase program, the Fed bringing out a bazooka with their unlimited QE program, cutting rates down to zero, and on Friday announcing as much as $2.3 trillion in loans to support the economy. And that is additional to the $2 trillion spending package or fiscal stimulus package that the government has already announced. Looking at the G7 major central banks, they have seen a total of $1.4 trillion worth of large-scale asset purchases performed in March alone. And according to Bloomberg, that is close to 5 times higher than the previous peak of $270 billion during the height of the global financial crisis in 2009. We've also seen governments stepping up to the plate with massive fiscal stimulus packages, and discussions of further stimulus measures already underway in the majority of G7 nations. Now, the third reason for recent optimism has been oil prices. After falling to basically the lowest level in almost 20 years, oil prices got a lift last week and the week before that, as it seemed that Saudi Arabia and Russia were willing to set aside their differences and find a solution to the current price war. Now, the jump in oil prices gave the market more reason to feel positive, especially on Thursday, when some sources claimed that OPEC were currently discussing production cuts worth of 20 million barrels per day, which was well above the previously touted 10 million barrels per day. However, oil prices like WTI tumbled close to 9% on Thursday, as the actual cuts were less than hoped for, and as Mexico basically rejected the current proposal, which which will require the country to trim output by about 400,000 barrels per day. Now, with the US shale industry also under pressure, we did see President Trump coming out over the weekend saying that the United States will basically help Mexico by offering to cut up to 250,000 barrels of that 400,000 barrels required by Mexico in order to get the deal through and stabilize the oil markets. Now, currently, as I'm writing this report and doing this video, negotiators from OPEC nations are in consultations with Mexico to try and find a resolution before the market opens. Now, the challenge facing oil prices is not just the short-term euphoria from a potential deal, but rather the incoming gravity from the massive global demand slump, which is estimated to be around 27 million barrels per day in April alone, and up to 35 million barrels in total, according to some sources. Now, taking all of the above into account, we think that the baseline scenario for global risk remains definitely firmly tilted to the downside despite the recent positive moves we've seen in risk assets, and the positive stimulus measures announced will certainly do a lot to cushion the economic fallout. But with the forced shutdowns and lockdowns causing many businesses to close, the expected recovery looks a lot slower than previously estimated and hoped for. Now, even though equities has put in a very impressive rally, there are plenty of respected analysts and economists out there calling this a classic bear market bounce, also called a sucker's rally for a very good reason. Now, it is very common for big bear market rallies to put in gains of over 20%, sometimes 25%, and history gave us good examples of this during the 2000 and 2008 market crashes. Now, another thing to consider is volatility, especially cross-asset volatility, which is a very important consideration. Even though volatility across various asset classes has definitely pulled off their peaks, they still remain very high, elevated, and suggest that there's ample amount of uncertainty left in the markets right now. Now, for the upcoming week, our focus will be on 4 specific areas, namely COVID-19, oil, US and Chinese data, and stimulus announcements. Starting with the virus, the big focus this week will be on whether we see further positive signs in places like Italy and Spain, whether that can be continued, and also whether we see that spill over into other hotspots like the UK and the US. Now, as long as the virus wreaks havoc across the globe, it'll be very difficult for analysts and economists to fully quantify the economic damage caused by the virus once the various lockdowns, government lockdowns are out of the way. That is why we do think economic data should play a secondary role, and the big focus will still be on whether a slowdown in the virus is seen in the numbers. Secondly, we need to consider oil prices in light of the current challenges between Mexico and OPEC. Apart from the US shale industry, which has seen a lot of pressure from that drop in oil prices, the majority of oil-dependent economies are feeling the immense pressure of that price drop in oil. Now, Mexico's defiance is putting the industry under a lot of pressure right now, as the reason for Saudi Arabia's drastic output increases and price cuts earlier back in March, and the reason for the collapse in the OPEC talks in March was due to Russia's unwillingness to cut. So the fact that Mexico is pushing that boundary is really putting the oil market under pressure, and that can see some potential impact in the risk sentiment this week as well. Now, the third variable to consider this week is the economic data. Even though we do think it will take a backseat, the economic data will give us a better view of the extent of the economic slowdown caused by the virus. The biggest data points to focus on will be US retail sales, and then a slew of economic data from China, which will include Q1 GDP, retail sales, exports and imports, as well as industrial production. Now, according to Nordea Investment Bank, this week's US retail sales could be the weakest retail sales growth number in the US history if the recent spend trend data is correct. A Reuters poll currently puts consensus for retail sales at -7% month over month, with a very wide range of estimates between 24% month over month minimum and a -0.9% month over month for the maximum expectation. Coming to Chinese data, it'd also be important with the Q1 GDP estimates ranging currently between -6% and -10%. These data points will provide some insight into the potential shock that COVID-19 lockdowns could mean for other countries. It is important to remember that even though market participants often doubt the accuracy of Chinese data, the market reaction could still provide short-term volatility that we do need to be aware of. Then finally, after the Fed's announcement of that big loan package worth $2.3 trillion, we need to keep track of whether the market thinks that the current responses being put in place by various governments and central banks has been enough, or whether more is needed, and any additional sizable stimulus announcements could see further short-term upside in risk assets. Then looking at potential dovish sentiment shift, the potential dovish shifts in risk sentiment this week week will result from the focus points mentioned previously, namely the virus updates, oil prices, and economic data. First up is the current OPEC dilemma. According to Chief Oil Analyst of Energy Aspects, the current storage space for oil is running out very fast due to the steep declines in demand. And in a recent article, Bloomberg reported that the world's main oil trading hub in the Middle East are turning down storage requests as they are running out of storage space. Now, once storage space has run out, it is very likely that oil prices will suffer yet another round of weakness and could set off another risk asset sell-off. Thus, a breakdown in the OPEC Plus deal can drastically influence oil prices as well as the Canadian dollar in this upcoming week. Furthermore, the economic data from the US and China will not take center stage, but it will shed some important light on recession expectations, which could shift risk tones into negative territory this week if the data surprises significantly to the downside. Finally, a big reason for recent positivity has been that slowdown in COVID-19 cases and fatalities. If we do see any drastic escalations that shows that the plateauing was short-lived, that could definitely risk tone shift back to negative and is something we need to pay attention to in this upcoming week. Then looking at potential hawkish sentiment shifts, this week's positive risk tone saw another round of equity rallies. Now at this point, it does seem that the market is looking for any short-term solace that it can find. The first focus area for us for markets, especially at the open, will be that OPEC Plus negotiations going on with Mexico. The downside in oil prices on Thursday will most likely mean that we might see some welcome bounce to the upside if a deal could be struck over the weekend. But one point of caution on this to remember is that even a agreed deal of 10 million barrels per day will not ease the overwhelming lack of demand or alleviate much of the current storage constraints, which is why our baseline for oil prices does remain tilted to the downside in the medium term, even though an agreement might see some short-term upside, which could support risk tone. Secondly, if US and Chinese economic data comes in better than expected, it might see some relief in the short term and can also see some positive risk flows. But just like oil prices, our baseline for equities do remain tilted to the downside in the medium term, which is why better than expected data will matter less than negative data this week. Another important aspect which might prolong the current positive equity run is any further positive signs that COVID-19 is continuing to slow around the globe. So far, the good news has been limited to places like Italy and Spain and South Korea. So if we do see that same plateau effect coming through in the US and the UK, that could be a very warm and welcome relief for markets and is likely to see some further positive risk flows as well. Finally, we've seen unprecedented monetary and fiscal policies and measures being put in place around the world, with the most recent bazooka being that Fed's US 2.3 trillion loan package. Further significant stimulus packages announced by the G7 could spur further positivity and see further upside for risk assets in the week ahead. Then looking at possible currency pairs to trade in line with the risk sentiment. In the case of a dovish sentiment shift which tilts the market into a risk off turn, we could expect high beta commodity linked currencies like the Aussie, the Kiwi, the CAD to weaken, while safe haven currencies like the Swiss franc, the Japanese yen, and the US dollar would be expected to strengthen. Thus, in a risk off environment, look to pair a strong safe haven currency against a weak high beta currency. Then in the case of a hawkish sentiment shift, which tilts the markets into a risk on tone, we would expect high beta commodity linked currencies like the Aussie, the Kiwi, the CAD to strengthen, while safe haven currencies like the Swiss, the yen, and the US dollar would be expected to weaken. Thus, in a risk on environment, look to pair a weak safe haven against a strong high beta currency. Remember guys that these recommendations are based on the current fundamental bias for these currencies at the time of writing and making this video and can change throughout the week. So make sure to reevaluate whether the short-term sentiment is still valid for these currencies before taking any trades. Then looking at possible economic news to trade into in line of the risk sentiment. The only economic data worth considering to trade into this week will be the US retail sales data or the Chinese Q1 GDP retail sales or exports and imports. However, as risk sentiment is best traded fresh, it'll be very prudent to evaluate the risk tone in the relevant trading sessions before committing to trade into any events.